Gold just did something that should be impossible. The Middle East is on fire. Bombs are falling on Tehran. Iran's Revolutionary Guard shut down the Strait of Hormuz. Oil punched through $100 a barrel. And gold, the one asset that every financial textbook, every seasoned advisor, every instinct you've ever developed tells you goes up in exactly this kind of moment, crashed. Not a small dip, not a healthy pullback. An 18.5% collapse from its all-time high, 7 consecutive days of losses, the worst 2-week performance since 1983. If you own gold, silver, or any precious metals exposure, and you don't understand why this happened, you are about to make the most expensive mistake of your financial life. Because in a market moving this fast, the wrong reaction to a crash costs more than the crash itself. I've spent 40 years watching markets behave in ways that seem to violate their own logic. And what I'm about to tell you is the most important financial distinction you can understand right now, not just about gold, but about how modern monetary markets actually function underneath the surface that most investors ever see. Gold is not broken. The rule most investors think governs gold is broken. And the gap between those two statements is where fortunes are either protected or destroyed in a moment like this one. But here's what makes this story truly extraordinary. The real lesson isn't why gold fell. The real lesson is what this crash reveals about the system underneath gold and why investors who understand that system, the ones Ray Dalio describes as genuinely prepared rather than merely reactive, are not panicking right now. They are preparing, because what happens after a crash like this, in the specific monetary configuration we are living through today, dollar up, yields up, war ongoing, gold falling, has a very clear historical pattern. And that pattern does not end where most people think it ends. Let me take you through exactly what happened, exactly why it happened, and exactly what the mechanism tells us about what comes next. Start with what I call the mechanism problem, because this is where almost every investor's mental model breaks down. Most people carry a simple cause and effect picture of gold in their heads. War happens, fear rises, gold goes up. It's in every financial handbook ever written. Gold did not read the handbook this time. Gold hit an all-time high of $5,589 per ounce on January 28, 2026. By March 19th, it had fallen to as low as $4,551. That is an $1,038 drop, roughly 18.5% in less than 2 months across 7 consecutive losing sessions, the longest such streak since 2023. And during every single one of those 7 sessions, the geopolitical backdrop was as alarming as it gets. Iran's Revolutionary Guard closed the Strait of Hormuz. Oil hit $100 per barrel. Bombs fell on Tehran. The Middle East entered its most serious military escalation since the 1973 Yom Kippur War. By the old handbook, gold should have been rocketing toward $7,000. Instead, it bled lower every single day. So either everything you believed about gold as a crisis hedge is fundamentally wrong, or there is a mechanism operating underneath this market that most retail investors have simply never been taught to see. I've been watching that mechanism work for 4 decades. Here is how it functions step by step, and why understanding it changes everything about the decision you need to make right now. The number you need to focus on is not the gold price. The number you need to understand is 4.25. That is the yield on the US 10-year Treasury bond as of March 19th, 2026. That single number explains more about why gold is falling during an active war than any analysis of the war itself ever could. Here is the chain reaction in precise order. The Federal Reserve held interest rates steady on March 18th, but simultaneously revised its 2026 inflation forecast higher, up to 2.7%. Fed Chair Jerome Powell explicitly cited energy price spillover from the Iran conflict, driving oil above $100 as the justification for maintaining a restrictive policy posture. When the Fed signals higher for longer, bond yields rise, the dollar strengthens, and gold, a non-yielding asset that produces no income, no interest, no dividend, nothing except the preservation of value over time, suddenly faces a brutally simple mathematical competition. It cannot win in the short term. When Treasury bonds pay 4.25% annually with zero default risk, backed by the full faith and credit of the U.S. government, investors face a genuine choice between two things: hold gold that pays absolutely nothing, or hold treasuries that pay 4.25% per year. When yields are low, 1%, 2% gold wins that comparison easily. The inflation protection and monetary security it offers more than compensate for the missing yield. But when yields reach 4.25% while the dollar is simultaneously strengthening, the math of owning gold becomes genuinely mechanically painful. You are paying an opportunity cost of 4.25% annually to hold an asset that just declined 18%. That is the mechanism, not the war, not the bombs, not the geopolitics. And here is the part that makes this crash particularly brutal and counterintuitive. The war actually made gold's situation worse, not better. The war drove oil above $100. Oil above $100 drove inflation fears. Inflation fears drove the Fed hawkish. The hawkish Fed drove yields to 4.25%. Yields at 4.25% drove gold lower. The war didn't save gold. The war is the reason gold is falling. Follow that chain, and you will never again be confused by a moment like this one. But there is a second mechanism operating simultaneously, and this one is what transformed a correction into a crash, not over weeks, but over hours. I call it the leverage unwind. And it is the mechanism that most retail investors discover only when it has already cost them their gains. Throughout 2025 and into early 2026, as gold climbed from $2,600 toward its January high of $5,589, retail investors poured more than $70 billion into gold ETFs. That is a staggering figure, and a significant portion of it flowed into leveraged products, 2x and 3x ETFs that multiply the daily price movement of gold by a factor of 2 or 3. These products have a design feature baked into their structure that almost nobody reads in the prospectus and almost everyone discovers at the worst possible moment. They rebalance daily, every single day. Regardless of market conditions, the leveraged ETF must adjust its exposure to maintain its stated leverage ratio. When gold falls, the ETF must sell gold contracts to rebalance. That selling pushes the price lower. Lower prices trigger more mandatory selling. More selling creates further price declines. The feedback loop accelerates and compounds until the leverage position is fully liquidated. And that liquidation can happen in a single trading session. This is not theory. Look at the price action from the day the Hormuz closure was announced. Gold initially spiked from $5,296 to $5,423 on the breaking news, exactly as the old handbook predicted. Then it reversed violently, falling more than 6% from that intraday high in a matter of hours. Paper traders flushing positions, leveraged ETFs executing mandatory rebalancing, margin calls triggering further forced selling. Nothing more structurally significant than that. But the destruction to the headline price number was catastrophic. The very products that had carried retail investors up to $5,589 became the exact mechanism that crashed the price back to $4,551 in 2 weeks. And here is the cruelest part of that dynamic. The retail investor selling into that crash was not selling because they changed their mind about gold's long-term value. They were selling because the product they owned was structurally designed to force them out under precisely the kind of volatility that corrections in bull markets produce. They weren't making a decision. The product was making it for them. And while that forced liquidation was cascading through the paper markets, something else was happening simultaneously, something that almost nobody in Western financial media is discussing, because it requires understanding a historical parallel that goes back 43 years. In 1983, gold suffered one of its worst weekly declines in decades. The reason had nothing to do with a financial crisis or a systemic banking event. It was Middle Eastern oil-producing states selling gold to raise emergency cash because their oil revenues had collapsed. OPEC's market share had been devastated by new production from the North Sea, Alaska, Brazil, and Malaysia. Saudi Arabia, Qatar, and Kuwait needed dollars to defend their currency pegs and fund their governments. The price of oil had fallen. The cash wasn't coming in. So they sold what they had. They sold gold, and that sovereign selling flooded the market and crashed the price. The mechanism in 2026 is structurally identical, only the trigger is inverted. In 1983, Gulf states couldn't generate enough oil revenue because the price was too low and supply was too high. In 2026, oil is at $100 a barrel, a price these governments would normally celebrate, but they cannot physically ship their production because the Strait of Hormuz is closed. Storage facilities are full. Saudi Arabia and Kuwait have already begun cutting production because they have nowhere to put the oil they're pumping. Revenue has collapsed, not because the commodity is cheap, but because the pipeline is blocked. And the same sovereign wealth funds that spent the last 3 years buying gold to build reserves for exactly this kind of emergency are now experiencing exactly this kind of emergency. Saudi Arabia holds 323 tons of gold. Qatar holds 815 tons. Kuwait holds 79 tons. These are not small positions, and they don't need to liquidate everything to move the market. They need to sell enough to cover the cash flow gap created by a Strait of Hormuz closure that has lasted far longer than anyone anticipated. The 1,983 playbook, run by the same category of players for the same fundamental reason, producing the same crash pattern. Layer this on top of the leveraged ETF liquidation and the Fed-driven yield surge, and the violence of this particular sell-off is not mysterious at all. It is precisely what the historical record predicts. There is a third layer amplifying all of this, and it operates with zero emotional input, zero geopolitical awareness, and zero regard for whether a war is happening or not. Hedge fund algorithms don't read the news. They don't watch CNN. They don't process the moral or strategic implications of a military escalation in the Middle East. They watch two numbers, the dollar index and the 1-0-year Treasury yield. The programming is simple and unambiguous. When the dollar index climbs above 99, sell gold. When the 1-0-year yield rises above 4%, sell gold. On March 19th, the 1-0-year Treasury yield hit 4.25% and the dollar index climbed toward 99.9. Both triggers fired simultaneously across hundreds of independent algorithmic trading systems. Billions of dollars in paper gold contracts were sold automatically, not because any human being decided the gold thesis was broken, but because preset mathematical conditions were met and the code executed. No judgment, no nuance, no awareness that Iran had just closed the world's most important oil shipping lane. The algorithm saw two numbers cross two thresholds, and it sold. This is the world gold trades in today, a world where the paper price is determined not just by the fundamental value of the metal, but by the intersection of sovereign cash flow crises, leveraged retail product mechanics, Fed communication strategy, and algorithmic trading triggers that have nothing to do with any of the reasons a long-term gold investor actually owns the metal. But here is where the story becomes genuinely important, not just for understanding what happened, but for understanding what it means. Because while every one of those paper market mechanisms was driving the price of gold violently lower, the physical market for gold was telling a completely different story. Physical gold premiums stayed elevated throughout the entire sell-off. Demand from private buyers, jewelry manufacturers, and institutional purchasers held steady. The Shanghai Gold Exchange continued trading at a premium to the COMEX paper price, meaning buyers in the world's largest physical gold market were paying more than the future screen said the metal was worth, because actual physical metal was what they wanted and they were willing to pay up for it. Asian central banks continued their purchasing programs without interruption. Physical gold is leaving COMEX vaults at an elevated rate, the same drainage pattern that was observable in the months before gold hit its January all-time high. The paper market and the physical market diverged as widely this week as at any point in the current bull market. I want you to understand what that divergence historically signals, because in 40 years of watching gold markets, this specific pattern paper, selling hard while physical demand holds firm, has not marked the end of a gold bull market. It has marked a transfer of ownership. Leveraged retail positions, forced out by the mechanics of the products they owned, transferred unleveraged institutional and sovereign buyers who are comfortable waiting months or years for the structural thesis to play out. The weak hands sell the paper. The strong hands take delivery of the metal. And when the mechanical headwinds reverse, the metal is no longer in the hands of investors who can be force liquidated out of it. So what are the two numbers that actually matter right now, the two signals that will tell you when the specific mechanical headwind against gold is turning? The first is the DXY, the US dollar index. When the DXY is above 100, gold faces a strong, persistent mechanical headwind. Every day, the dollar stays strong, gold is more expensive for holders of other currencies, and the algorithmic selling triggers remain active. But when the DXY breaks back below 97, which happens when the market begins pricing Federal Reserve rate cuts again, that headwind reverses. The dollar falling and the algorithms buying are the same event. Watch the DXY. It tells you more about the short-term direction of gold than any war, any election, or any geopolitical development. The second number is the 1-0-year Treasury yield. At 4.25%, the opportunity cost of holding gold is at its highest point in years, and that cost is the mathematical engine driving the paper sell-off. When that yield drops below 3.5%, which happens when recession fears begin to override inflation fears, or when the Federal Reserve is forced to cut rates, the opportunity cost of holding gold collapses and the mechanical selling reverses. Here is what makes the current configuration uniquely important in the longer arc of this story. The United States is rolling over $9.2 trillion in debt this fiscal year. At a 4.25% yield, that debt costs $391 a billion more annually than it did when rates were at 2%. The total national debt stands at $36.2 trillion. Annual interest payments have already exceeded $1.03 trillion, the first time in American history that the interest bill has surpassed the defense budget. The arithmetic of sustaining 4.25% rates against a $36.2 trillion debt load is not permanently maintainable. At some point, that math forces a policy response, a rate cut, a form of yield curve control, a return to quantitative easing under whatever name the next Fed chair chooses to give it. The moment that response comes, every mechanical headwind against gold reverses simultaneously. And when it reverses against the backdrop of central banks buying 863 tons of gold per year against a structural de-dollarization trend that did not pause for one single day this week, against J.P. Morgan's unchanged year-end price target of $6,300 per ounce, and Deutsche Bank's unchanged target of $6,000, the reversal will be fast, and it will recover this correction and more. Neither J.P. Morgan nor Deutsche Bank move those targets despite seeing the same FOMC decision, the same dot plot revision, the same oil shock data, the same 18.5% price decline that every retail investor was reacting to. They looked at all of it and held their projections. That is the signal that matters most, not what institutions say in press releases, but what they do with their price targets when the short-term price moves violently against them. In 1983, gold fell sharply, then entered a multi-year consolidation. The investors who sold at the bottom of that crash and waited for the chart to confirm a reversal before re-entering missed the entirety of the next bull market. The investors who understood that the 1983 crash was a sovereign cash flow event, not a structural change in gold's monetary role, accumulated patiently through the noise and held. The configuration today is not identical to 1983, but the mechanism is. There are two types of investors in this moment. The first type watched gold fall 18% during an active war and concluded that the gold thesis is broken. They sold. They locked in losses. They will watch the recovery, which J.P. Morgan and Deutsche Bank are both still projecting at levels 30% above current prices from the sidelines. Not because they were wrong about gold's long-term value, because they mistook a short-term mechanical price for the structural price, and because they own leveraged products that were specifically designed to force them out under exactly the kind of volatility that corrections in bull markets routinely produce. The second type understands that there are two gold markets operating simultaneously. The paper market, which crashed because yields rose, the dollar strengthened, leveraged positions were forced liquidated, and Gulf sovereign funds sold gold to cover the cash flow gap created by a blocked oil shipping lane. The exact 1,983 playbook executed by the same category of actors for the same fundamental reason. And the physical market, which held because the property that makes gold genuinely valuable, the absence of counterparty risk, the absence of an issuer, the absence of any promise that can be broken by a political decision, did not change when the Federal Reserve revised its dot plot. The price changed, the property did not. The structural conditions that drove gold from $2,600 to $5,589, the debt cycle, the de-dollarization trend, the fiscal arithmetic of a government paying more in interest than it spends on its military, none of those changed on March 18th. The dot plot changed, the short-term mechanical price changed, the structure did not. In 40 years, I have never seen the paper price and the structural price remain separated indefinitely. Watch the DXY, watch the 1-0-year yield. When the dollar breaks below 97 and the yield breaks below 3.5%, the mechanism that crashed gold reverses, and it reverses against a backdrop that has not changed at all. The paper market crashed. The structural case did not. Now you know the difference. And knowing that difference is the most valuable thing you can take from this moment into whatever comes next.